Related party disclosures, uncovering the connections behind the numbers. Candimentor, candimentor.com. Welcome. This is a clear step-by-step guide to IND AS 24. I'll walk you through what to spot, what to disclose, and common traps with tiny examples and short pauses. End. 1. Objective and overview. IND AS 24 is the Indian accounting standard on related party disclosures. Its job is simple: make relationships and transactions visible in the financial statements. Why? So users, investors, lenders, regulators can judge how relationships might affect results. It applies to both consolidated and standalone financial statements. Think, identify the link, describe the deals, show the balances. 2. Why related party disclosures matter. Related party deals can be different from normal market deals. They may not be at arm's length. That creates risk. Disclosures help spot conflicts of interest, fraud, or undue influence. Investors and auditors use these notes to judge governance quality. Tiny example: a company sells land cheaply to a firm owned by the CEO's family. That needs explaining. 3. Scope and applicability. IND AS 24 applies to all entities that report under IND AS, public or private. If a relationship exists, you must disclose it, even if no transactions happened. One exception: in consolidated financial statements, transactions entirely within a wholly owned group are usually eliminated. But document the relationship somewhere, even if you eliminate the amounts. End. 4. Key definition: related party. A related party is a person or entity connected to the reporting entity. There are two buckets: person-related and entity-related. A. Person-related. A person or close family is related if they control or jointly control the entity, have significant influence, or are key management personnel, KMP, of the entity or its parent. B. Entity-related. An entity is related if it belongs to the same group, is an associate or joint venture, is a post-employment benefit plan for employees, or is controlled or significantly influenced by a related person or another related entity. 5. Key terms explained. Control: the power to direct policies to gain benefits, usually more than 50% voting or equivalent contractual power. Joint control: shared decision power under an agreement. Significant influence: power to participate in decisions but not control, often around 20% voting. KMP: key management personnel. These are people who plan, direct, and control the entity's activities. 6. Close members of family. Close family includes spouse or domestic partner, children, and dependents. Also people dependent on the person financially. Example: if the CEO's son runs a supplier, that supplier is a related party via family link. 7. Relationship mapping: how to identify. Practical steps to find related parties. 1. Ask who controls or significantly influences the entity. 2. List key management personnel. 3. Identify entities those people control. 4. Check for joint ventures, associates, overlapping boards. 5. Look for cross-holdings and common directors. Keep a related party register and update it at least once a year. 8. Examples of related party relationships: parent and subsidiary, obvious control link; an associate, large minority stake giving significant influence; a joint venture, shared control under contract; KMP, CEO, CFO, executive directors; family influence, relatives owning supplier or customer businesses. Tiny example: Company A owns 60% of Company B. B is a subsidiary of A. What is not a related party? Not every connection is a related party. Examples not related: two companies that share a passive shareholder without control. Regulatory bodies just exercising public powers are usually not related. Ordinary customers, suppliers, or lenders on normal market terms are not related, unless control or influence exists. 10. Related party transactions, meaning a related party transaction is any transfer of resources, services, or obligations between related parties. It does not matter whether money changed hands. It does not matter whether terms look normal. Examples include sale or purchase of goods, services provided, loans, guarantees, and management contracts. 11. Recognition versus disclosure. Recognition: record the transaction using normal accounting rules. Do not remeasure simply because it is related. Disclosure: explain the relationship, the transaction terms, and the effect on the financial statements. Even if the transaction value is zero, disclose the existence of the transaction when a relationship exists. 12. Measurement. Arm's length principle. You record transactions at the agreed transaction value. You do not remeasure to market. But you must disclose whether the terms were at arm's length. If pricing looks biased, auditors and regulators will probe the basis for the price. 13. Disclosures. Minimum requirements. For each related party relationship, disclose at least the nature of the relationship, for example, subsidiary, associate, KNP, a description of transactions and the total value during the period, outstanding balances at the reporting date, such as receivables and payables, any provisions for doubtful debts related to those balances, expense recognized for bad or doubtful debts, key terms and conditions like pricing and settlement terms. 14. Disclosure format example. When you present disclosures, be clear and consistent. State the nature of the transaction, the related party, the amount, and any balance at year-end. Also show short-term notes. For example, interest-free loan or market rate for services. Tiny example line: loan to director, amount 1 million rupees, outstanding at year-end 1 million, interest-free. 15. Key management personnel, KMP disclosures. KMP compensation must be disclosed by category. Categories include 1. Short-term employee benefits, salary, bonus, allowances. 2. Post-employment benefits, pension, gratuity. 3. Other long-term benefits, long service leave, leave encashment. 4. Share-based payments, employee stock option plans, ESOPs. 5. Termination benefits. Total KMP compensation is disclosed by category, not usually by name, unless another law requires individual disclosure. 16. Related party transactions through subsidiaries. Look beyond direct links. Control can be indirect. If parent controls subsidiary A and A controls subsidiary B, transactions between parent and B are related party transactions. Also disclose cross-group transactions, such as between fellow subsidiaries. End. 17. Government-related entities, special case. If a government controls, jointly controls, or significantly influences an entity, special rules apply. You may aggregate disclosures for transactions with government-related entities when similar in nature. Also, name the government and describe the nature of the relationship. Example: a public sector bank transacting with other government-controlled entities would disclose aggregated amounts. 18. Consolidated versus standalone disclosures. Standalone financial statements disclose the entity's own related party transactions. Consolidated financial statements eliminate intragroup transactions. Disclose only transactions with related parties outside the group. KMP disclosures are often presented at consolidated level to show total group compensation. End. 19. Timing and period of disclosure. Disclose transactions that occurred during the reporting period. Also report balances outstanding at the reporting date. If material events happen after the reporting date, disclose them if they are relevant to user decisions. 20. Common mistakes and red flags. Watch these traps. 1. Missing indirect relationships through family or associates. 2. Omitting year-end balances even for old transactions. 3. Labeling everything arm's length without evidence. 4. Incomplete split of KMP compensation by category. 4. Forgetting group eliminations in consolidated statements. Each omission is a red flag for auditors and regulators. End. 21. Audit and compliance focus. Auditors test the related party disclosures for completeness of the related party list, correct identification, especially family links, existence and valuation of reported transactions, accuracy of disclosures and cross-checks with the management register. Be ready to provide documentary evidence for arm's length pricing. End. 22. Linkages with other standards. IND AS 24 connects to other standards. IND AS 110, control definitions and consolidation rules. IND AS 28, associates and joint ventures. IND AS 19, post-employment benefit plans. IND AS 1, general disclosure principles. Also follow legal rules under the Companies Act 2013, Section 188, for approvals and limits on related party transactions. And always ends. 23. Real-world example, Infosys Limited, 2024. Infosys discloses related parties, such as subsidiaries, associates, joint ventures, and KMP and their relatives. They list transactions like intercompany loans, services, and managerial remuneration. They also state that those transactions were at arm's length. This demonstrates the clear table format and narrative explanation investors expect. Quick decision matrix. Use a quick rule of thumb. Subsidiary or parent, disclose. Control exists. Associate or joint venture, disclose. Significant influence or joint control exists. KMP and relatives, disclose. They influence decisions. Common customer or supplier, generally no disclosure unless control or significant influence exists. Government entity, limited or aggregated disclosure with name of government. 25. Closing summary. IND AS 24 forces transparency about who influences whom and what deals they do. Identify relationships, document them, and disclose transactions and year-end balances. Be rigorous with KMP disclosures and indirect links through family or subsidiaries. Missing or weak disclosures raise audit and governance flags. Clear, complete related party notes build trust and protect the business.